So, over $65,000 in profits with stock options in just under 3 months, in one of the most unconventional ways that you ever really realized you could do stock options with. That's what we're going to break down in this video right here. So, we're going to dive into my Charles Schwab account. The account value on the main side is now over $1.2 million. But there is a trade that I made a couple months ago where I made, like I said, over $65,000. And it's one of the more unconventional takes of how stock options actually go down, because most people think, oh, you have to buy this stock and do it right before earnings come out and hope that the stock doubles in price, then you can make $65,000 or whatever it may be. That's not the right way to do stock options. The way to do stock options, in my opinion, is what I'm going to outline in this video right here. And I'll show you a few different strategies that I do on this specific company, and you could probably already guess it's going to be United Health. But for the point of this video, it doesn't matter what the company is, because the process and the system that I use on United Health, it's going to apply to really any company. So maybe you don't like United Health, and that's fine. You could use this system, and I'm going to show you on really any company that checks the boxes that we're going to go through here. So let's dive back into this account. All right, so let's start super high level first. We'll go through some of the trades I have open overall, but then we're going to dive into United Health. There's a total of 4 plays that I have open right now. And you're going to realize that, man, I never really thought that you could do options in that exact way. So we'll get to that in 1 second. But overall, triple Q, VOO, that's the base portfolio. In this specific account, that's roughly 950,000. That makes up a really big chunk of it, 37 and 36%. Tesla I have a little bit, United Health have a little bit, obviously, and then BLV, which is kind of just like something that will track the price of what bonds do. So if yields go down for whatever reason, maybe Trump makes the yields go down somehow, or Jerome Powell gets fired, or the economy crashes, whatever happens, this will go up in share price if yields go down, because bonds and interest rates move opposite of each other, the price versus the yield. So that is a hedge play that I have right now. But let's dive into United Health and let's talk about it. So everybody knows, I'll just go to the chart of United Health. We'll look at that. Everybody knows that United Health is down quite a bit in the last, 6-ish months, whatever it may be. Here's a 1 year chart, and you could just see if we go from peak to trough, it's down roughly 62%, which is pretty crazy for a company that is literally as big as United Health. Now, why did United Health stock fall? We could see right here. How sick is United Health? How a wave of bad news wiped $280 billion off of the insurer's stock value. There's another negative article right here. United Health Group stock price near 5-year low as bad news piles up for the healthcare giant. And the key reason why overall United Health is falling, we don't have to go into the nitty gritty, because I want to get into the option strategy of how it really just prints money if you do it right. United Health is a company, obviously one of the biggest health insurance companies in the entire world. Bad news came out, which it was true, that medical costs are rising. And when medical costs are rising, United Health has to pay out more in claims. When they pay out more in claims, their profit margins are going to fall. What does that mean when profit margin falls? The earnings per share goes down. And as we know, and we talk about on this channel time and time again, the number one thing that moves the price of a stock in the long run is what the earnings per share does. So if earnings per share gets cut in half, the stock should probably get cut in half too. But if we go back to the United Health chart, remember, the stock went down roughly 62%. Did their earnings per share actually get projected down 62%? No. So what happened right here, and let me flip to a 5-year chart, it's kind of easier to see. This was a full-blown panic sell of people in the market just freaking out saying, oh my God, they're never going to make it out of this. The costs are going way up. How are they ever going to catch up? Well, guess what? This isn't an inherent problem solely to United Health. There's a bunch of insurance companies out there that have the same problem. The cost of insuring people is going up. And guess what you're going to do? You're going to raise prices. It's going to be that simple. If United Health raises their prices, so is Cigna, so is Centene, so is all these other main medical companies out there. They are going to raise their prices too in order to maintain their profit margins. And when I was just listening to the earnings call on United Health, I remember them talking about, we're going to get through this. It's going to be okay. Earnings per share is going to get back to growth. We're kind of just guiding bad right now so that we could put the bottom for the stock in, and then we build from here. So they reported, and I remember the stock fell quite a bit once that happened. And then news came out that the CEO was buying the stock. Everyone's like, oh my God, why is the CEO buying the stock when the stock is going down? What is he doing right now? Well, dude, he's the CEO of the freaking company. You don't think that he realizes, hey, maybe this stock is on sale, and hey, maybe I'm going to be rewarded handsomely if I buy the stock on the dip and make the share price go up? Like, that's what CEOs are supposed to do. They're supposed to bring value to the company. So the CEO bought, I bought, And then lo and behold, a few weeks after I bought, it came out that Warren Buffett on Berkshire Hathaway, they bought United Health stock too. And we're all probably looking at the same thing. It's a company that has a durable competitive advantage. They have pricing power and they have a moat. And again, it's the biggest health insurance company in the world. Everybody needs health insurance, whether you get it or not, whatever. But this isn't a company that's going to go away. United Health is here to stay. They're going to raise prices and they're going to get back to their profit margins. So, with that being said, let me show you a quick little chart right here of United Health's earnings per share projections. And again, I always end up in the way here, but let me move myself out of the way. So, again, like we talked about, to keep this very simple, the number one thing that matters for the price of a stock in the long term is what the earnings per share is projected to do. So from 27 to 16, what is that percent down right there? That is not down as much as what the stock went down. Like if we cut 27 in half, we're going to be down to roughly 13 bucks a share of earnings per share. This is at 16.24, and I bet you that they're probably going to beat that for 2025. So just by simply looking at this chart, you could see that this is maybe like a 30 to 40% drop of earnings per share. But why did the stock fall so much more? Why is the stock down, like we said before, 60%, 61, 62%, whatever it came out to be? Why? Because humans are emotional. They blew it out of proportion. The stock went down way more than what it should have went down. And even when the stock was, before this dip happened, the stock was fair value in my opinion. It's not like the stock was trading at a fundamentally astronomical valuation level. It was trading at a very fair valuation level. Then it fell even more from right there. So if we go back to the chart, let's draw a couple conclusions right here. And then I know you want to look at the stock options, but this is the research that you have to understand before you go do the options play, because it's about what the stock's going to do. If we think the stock is going to go up, we have to build conviction by doing a little bit of research. If we build conviction, then we move on to the next step by making a play on it, of course. So let's take a look at this. If we go to 2027 earnings per share, it's projected to be roughly 21 bucks per share. So we'll say that at the end of 2022, it's roughly the same number, $22 versus 21. It's basically the same thing. So what was the price of United Health at the end of 22? Well, if we just go over here, it's roughly 550 bucks per share. Now it's at 344. But dude, when we were deploying options, we were in this mid 200 range. So it's like this is pretty obviously a company that's on sale, and it's no surprise that Warren Buffett bought. So I honestly think these numbers right here are a little bit too bearish. I think they will be better than this. But then again, look at revenue. Revenue is going to keep growing. This is an earnings per share issue. They're going to figure it out. They're going to raise prices. They'll bring in more revenue. It's probably going to be fine. Of course, nothing is guaranteed with this stuff, by the way. But let's go back into the Charles Schwab account and let's look at the options plays just so you could understand the logic behind this, because most people really get this all wrong. Most people really think that in order to make money with stock options, you have to do 5 trades a day and stress yourself out all day looking at tickers all day long. That is not how you make money. Maybe you get lucky making money that way. I don't want to have to get lucky to make money. I want to do some research, build confidence, make a play, and then be patient and wait on it. So, this one play alone, like I said, over $65,000. If you just add this up right here, it's like 65, 182 in roughly 3 months. So, what did I do? The first thing that I did was I sold some put options. So, I sold some 230 puts that expired 12/17 of 2027, 10 contracts. And when I sold those puts, I collected $42,000 in premium. So, what that means is I sell the put and then I immediately get that cash credited in my account. So, right here, I have 613 bucks in cash. This would have said 42,393. So, I took that cash, I bought some shares, and I also bought some call options. So you could see my basis on my shares right here is roughly $40,000 on the shares, and I'm up like, only $9,000, but it's still good. I'm up 22% right here. But the big money is made on the call options that I bought, where I bought this one Leap contract right here. A Leap is just a call option that's more than 1 year. I did a 240 call for basically 2 years out, and I did 3 call options here that are basically 2 years out also. And when you look at this chart and you understand where earnings per share is probably going to go, you know that the stock is probably going to go where the earnings per share goes to. I didn't think it was going to happen in 1 year or maybe like, less than a year, whatever it may be. I knew that this would be a play that is going to take maybe 2 years for it to actually work out. So that's why I chose to buy shares, because obviously there's no expiration date on the shares. And the call options that I did, I gave myself a 2-year window because I really want to give myself enough time to capitalize on the big move that I was expecting to come. So then I bought the call options. And a quick little thing about call options too is if you hold these leap call options for more than 1 year, they get taxed at long term capital gains. So it's beneficial. And again, that's the only stock option strategy that you could get long term capital gains. So it's great. I'm probably going to hold these for at least a year, but of course, it depends on. Maybe it goes to the moon and I want to close it out early. I'm not going to let the tail wag the dog of, the tail being taxes and a dog of the actual play itself. If it makes sense to trim, I will trim. I'm not scared to do that and pay the taxes. But the thing that most people don't understand is the whole selling put option thing right here, where again, I collected $42,000. And what this really means is as long as the share price of United Health stays above $230 per share on expiration date of 12/17 of 2027, this contract is going to expire worthless. Because what does this put option allow the typical person to do? It allows them to sell their shares for $230. I am selling them that right. They paid me 42K to allow them to sell me their shares for 230 bucks. Why would I not want their shares for $230 anyways? Like, wouldn't that be a deal? Like, dude, United Health right now is 344 bucks per share. You're telling me that you don't want to buy them for 230 bucks per share? I would. Give me all the shares that I could get. That is what I'm doing right here. When the sentiment is down, when the stock is down, let's go back to the chart again. When this dip happened, everybody was freaking out. All the negative news articles were coming out. People were panicking about United Health. That is the time to get bullish and that is a time to get greedy when you want to sell options like that. Because when this market's falling, people are saying, oh my God, it's at 300. It's going to go to 200, then 100, then they're going to go out of business. So they're willing to buy more downside protection. They're willing to pay more for a put option, for example. Who are they buying that put option from? They're buying it from me. So I'm selling them this put option, and this breaks down to $42 per share in premium that I collected. So in reality, even if this goes below 230 bucks per share, I'm still ahead. Let's just call it 40 bucks a share to make even numbers here. My break even is roughly $190 per share because this premium that I collected, I keep that premium no matter what. So I take the premium, I buy shares, I buy calls. I'm like triple bullish on a company right now. And I'm basically getting shares and call options for almost free because somebody panicked and they bought a crap ton of put options. And I just sold them those options when the market was down and they were freaking out. So this strategy right here, this is how I scaled to a couple $1,000,000. I have more accounts than just Charles Schwab. But this strategy right here, it works on pretty much every company. Of course, it doesn't make sense to do it on every company at every given time. But when opportunity comes, and it always will come, this is a strategy that I've been using for years now. And it also works when something is expensive. Like if you think a stock is going to go down in price, you could sell calls or you could buy puts. So this works both ways. You can make money when you're bullish or bearish at the same time. And honestly, it's like one of the best things I ever discovered. But really, like it took me a decade to figure this strategy out. I've tried day trading, I've tried swing trading, I've tried technical analysis, I've tried every single strategy out there. This is what works for me. There's thousands of people that it works for too that went through my course below. It works. So if you got a lot of value from this video, be sure to like and subscribe. It'll really help out the channel a lot. And with that being said, I'll see you in this video right here.